Alhamdulillah, salatu wassalamu ala rasulillah. Thanks everyone for joining us tonight, this late in the evening on Sunday. For some of us who've joined here, it's an early evening or late afternoon for them. Just wanted to thank everyone for attending one of our webinars. I hope it is beneficial. Let's start off with reading a part of the Quran where Allah says, Ya ayyuhalladhina amanu idha tadayantum bidaynin ila ajalin musamma faktubuh. Allah says, O believers, when you contract a debt or a loan for a specified period of time, write it down. وَلْيَكْتُبْ بَيْنَكُمْ كَاتِبٌ بِالْعَدْلِ. And let the scribe who's writing it, he should write or she should write in justice. Basically, everything that we do as brothers and community members, when there's a transaction that we're doing with in any regard, doesn't have to be any specific loan, doesn't have to be specific a debt, doesn't have any contract that we make, we have to write it down. It's one of the commands that we have from our God Almighty, Allah subhanahu wa ta'ala. Moving on, I would like to hand this over to Brother Abdul here, who would introduce our speaker for today.
Okay, Jazakallah. Thank you, Hyderabadi. Assalamu alaikum, everyone. And hello, MINEKA again. You know me. So, to Hyderabadi, you can take care of admitting people. So I stopped doing that. Okay. So, yeah, so everybody, MINEKA is a certified CPA here. She is providing her services to my brother who lives in California. So I came to know about her through him. So then I realized that, if we can take her knowledge and see if the community can benefit from her knowledge that she can share with us today when it comes to taxation, retirement, planning, real estate, investments and everything. So hopefully we all can benefit from her valuable knowledge here. And thank you, MINEKA, again for providing your schedule today. We are all very thankful to you, and we hope we can, get some good information from you. So yeah, you can take over from here.
Sure. Thank you so much, Abdul. So I will go ahead and share my screen. Can everyone see my screen?
Yeah, I can see.
Okay, cool. Hi guys, this is MINEKA Singh. I'm a CPA here in California. I've been practicing CPA for almost 20 years now. And I do provide accounting, bookkeeping, taxation, and all kinds of services here and all over the US. As you can see on the first screen, my phone number is right here. So please, if you are interested, take it down, and my email address is here as well. I'll go to my second slide. As Abdul had reached out to me and he had explained it to me what people are looking for. So I had created this PowerPoint presentation. I hope this is going to be beneficial. And if you guys have any question in the middle of the presentation, please let me know or let Abdul know, and then I'll try to answer as much as possible. If you, for some reason you can, please email me or call me, and I will be happy to answer you guys. So I'll start with the first slide. There are two types of income earning. One is through W-2, and the other one is 1099 consulting or business income. W-2 is the most popular income earning in the US. And a lot of people, after working in the W-2 arena, they start venturing out in the 1099 consulting business. So there are ways you can make money. And I think I am gonna present how to plan if you are a W-2 earner, or how to plan when you are a 1099 consulting, or if you have your own business. So as you can see, this slide is for the W-2 earners, and there are only a few options we have as working on a W-2. And the first one, and it is most important one, is this 401k plan. I tell everyone, whoever is a W-2 earner, they should contribute to 401k if their lifestyle permits them to do so. As you can see, you get a deduction right away. So you don't pay tax on that income, which is in the 401k plan. And the limit for 401k plan is $22,500 for the 2023 tax year for anyone below age 50, and $30,000 limit for anyone above age 50. The limit has definitely changed quite a bit as compared to 2022 tax year. And this change is coming from January, not in 2020, we still pay same 20,500 or 25,000 limit. And a lot of employer will provide you employer matching, which is generally up to 4%, up to 25% of your contributions. This can vary, but big companies, generally they will contribute up to 4%. So it is a big deal. If you put money in, you get employer matching, you save for your retirement. So I highly recommend 401k plan for anyone working on a W-2. Any question, guys, before I move to the next slide?
No, we are good.
Okay. Okay, so that's the 401k plan. It's highly recommended.
And these limits, MINEKA, are for family, right?
This is per person, because if you work, suppose you work and your wife works, so you can contribute 22,500 and your spouse can contribute 20,500. So it's together, 44,000 or 45,000.
Okay.
So it is a good deal to have, and you can avoid taxes. It's not avoid, it's a tax deferral. So you can defer your taxes, when you start taking money out when you're old age.
Okay.
We also join it.
Okay, so the next slide is the other option you have is traditional IRA, Roth IRA, and backdoor Roth IRA. So the traditional IRA, which as you can see, it's fully deductible in the year of contribution. And the limit for traditional IRA is 6,500 for anyone below 50, 7,500 for anyone older than 50 years. This is my favorite. If you are not in 401k plan, this is my favorite because you can save taxes, you will save, and your contribution will grow and deferred until you take the money out from your traditional IRA. I also recommend this people if the employer is not offering 401k, or if suppose husband is working and husband has a 401k plan, but the wife doesn't work, she doesn't have any plan. So you as a family, you can contribute 6,500 for your wife. And so she will have some retirement account, and her retirement will grow, and over the time, when she turns 65 or 70 and a half, she can take money out penalty free. The other thing I always recommend people, 401k or traditional IRA, always do Roth conversion. And the Roth conversion happens only, and you should, it's not required that it should happen only during the low taxable income year. You can do anytime, but mostly recommended to do it in the low taxable year. For example, you are 50 years old, you got laid off, you didn't make money that year. Maybe that's the year if your money's sitting in the retirement account, 401k or traditional IRA, just convert them at least up to the standard deduction. If as a married, you're getting standard deduction of 24,100, you can convert a portion, 24,100 from your 401k or traditional IRA, and you will pay no tax. So the concept is you contribute money, you take a deduction, you don't pay tax during your prime years, and the years you don't make money or there is no taxable income, that's the year you convert it to Roth. So that's called Roth conversion. And whenever you have money in your retirement account, like traditional IRA or 401k plan, there is a required minimum distribution. The term is RMD at the age of 70 and a half. So that is another triggering factor that if you don't want to be in that RMD phase, you should do Roth conversion before you reach 70 and a half as much as possible. The next topic is Roth IRA. Roth IRA is not deductible. If you put money in Roth IRA, you don't get any deduction. You pay tax. It's an after-tax contribution. And As you can see, the limit is still the same as traditional IRA, 6,500. And there is an AGI limit. As you can see, AGI is the short form for adjusted gross income. And as you can see, the limit is for single is 138 to 153,000. For married is 218 to 228,000. If you are not looking for a tax saving or tax break, Roth IRA is another option to put money. Any money you put in Roth IRA, any earnings happening in that account will grow tax free. So when you take money out at the age of 70 and a half, you don't pay tax on the earnings. So it grows tax free. That is the beauty of Roth IRA. There is no RMD. There is no required minimum distribution at the age of 70 and a half. Whereas traditional IRA, you do have that requirement. So those are the two another lucrative options people have. Please feel free to use it, traditional IRA, Roth IRA, if you are in the AGI category. The third thing is backdoor Roth IRA. This is still legal within the IRS system because IRS has provided this option to a lot of people and they don't know about it because they think that, okay, if their AGI is above 228,000, they cannot put in Roth IRA. So the way it works, you contribute to a traditional IRA thinking that you will get a deduction. And when you are set and done with your tax return, you realize that, oh my gosh, I'm not getting any deduction. Then you move it to your Roth account. And that's what it's called, Roth, backdoor Roth IRA. If you deal with any brokerage firm, Fidelity, Charles Schwab, they all are aware of this rule. So I highly recommend this as well, backdoor Roth IRA, because money will grow tax-free in this account. You don't get a deduction, but at the same time, when you take money out after your retirement age, it's tax-free money. So these are the three things I just wanted to point out that this is a big deal and everyone should take advantage of these options. Any question on these ones?
So there is a question from Brother Askar. His question is AGI is for max range.
Mm-hmm.
Can you elaborate on that, MINEKA?
For which one, Abdul?
AGI is for max range. He posted a question in the chat.
Uh-huh.
So he has a question on that.
Okay, let me see the question. AGI is for max range. Yes, that is for the max range. Yes, absolutely. Because what they are saying that, okay, if your AGI is like, suppose take merit 218 to 228. If your AGI is 300,000, then you cannot put it in there. You cannot put in Roth IRA. That's when if you have 300,000, go with the backdoor Roth IRA. You put in traditional IRA, then move it to Roth IRA, and your brokerage firm will do it for you.
I have a question, MINEKA.
Yeah.
For the traditional IRA, do you, like the money that you have contributed, that's the only amount that you can do when you do the Roth conversion, or is it the value that you have at present with the growth value?
The present value. So suppose you contributed 6,500 over 10 years. So you have 65,000 plus earnings. Suppose earnings is 15,000. So you have 80,000 in your account. You can convert entire 80,000. You will pay tax on that, but you will not pay penalty.
Okay, thank you.
Yeah, that's why the Roth conversion is a very lucrative option. So if you take money out from traditional IRA for some reason, you will end up paying penalty, 10% penalty to Fed and 1% to the state. But in Roth conversion, that is not the case.
Okay, thank you.
MINEKA, what do you recommend for the students who are working part-time, or do you want them to put their money in traditional or Roth IRA?
If they are students and if they don't need money, I would recommend them putting in Roth IRA because their money usually, I give chores to my kids and I don't pay them. I pay them, once a month, and I don't give them money in their hand. I put it in their bank account. So if they add up to like 3,000, I put it in Roth account. So I'm paying them, I'm paying my kids, they have some earnings, and at the same time, I don't want a deduction. They are not looking for a deduction and they are not looking for any tax savings. So for students, I think I would recommend go with Roth IRA because the money is gonna go tax free and they will have money in their hand when they turn 60, 65.
If if, for example, if they are working for some other company and if they are getting the W-2, so what do you recommend? So do they need to do the traditional or the Roth?
If they are in a full-time job, like, they finish their studies and they are working, I would recommend traditional IRA because they need to, traditional IRA or 401k, big time, because they need to save for their old age.
What about if they are part-time?
It just depends. I mean, how much money they are making. Do they need it now, later? If they're making like below 20,000, I would say Roth IRA. If they are making more than 20,000, I would say just go with the traditional IRA or the 401k.
And then they can do the conversion later on.
They can do the Roth conversion, yeah. Because if they are not working certain years, they can do Roth conversion. Yes, definitely.
So in this scenario, if the conversion can be done before the end of the year, or it can be done what is the scenario?
Yeah, so Roth conversion always have to happen on before December 31st, on or before.
So then once the conversion is done, then they can change it back to traditional, and then they can follow, and then at the end of the year, they can do the conversion again.
So the way it works, yes. Suppose, you made money this year, 6,000, you put it in your traditional IRA, and you decided, no, I don't want to put in traditional, I want to convert it. You can convert it in the same year before December 31st. If you want to take the advantage in the same year, you can do it next year based on your tax situation as well. But if you want to take advantage of anything, it has to happen December 31st.
So is it a bi-directional or just a unidirectional? So once you are converted, can you go back to traditional again the following year?
Yeah, so the conversion happened, so that money is gone. That is gonna go sit in Roth. That same money cannot go back. But if you want to put in traditional, you can go back and put in traditional. It's fine.
Okay.
Okay, any more question, guys?
Is there any events at which we can withdraw the money from the IRA accounts, like you're buying your first home or something like that? Can you withdraw some money?
Yeah, you can. I think if you have health issues, first-time home buyers, yes, those are the options available from traditional IRA. But if you are trying to withdraw money from your 401k, I would say do not withdraw money from 401k because you will end up paying penalties because 401k is very limited. They don't even have as much as options as traditional IRA options. I would say go take a loan because when you take loan from 401k, technically you're loaning to yourself. You pay yourself and then you pay the loan back. But that is a good deal with the 401k. Okay, I'll move to my next slide. So this is the difference. I know Abdul had told me when he doesn't know the difference. So maybe after me explaining all those three things and putting this next to each other, Roth IRA and traditional IRA will help alleviate some of the questions or things will make it clear for you guys. So as you can see, this is 2022 numbers, but as you know, 23 number is going to be 6,500 for both. The pros are qualified withdrawals in retirement are tax-free in Roth IRA. Contributions can be withdrawn anytime. So if you take money out at the retirement age, it's free, tax-free. And contribution, the money you had put in from your pocket is withdrawn anytime tax-free. No issues, no penalties. In traditional IRA, deductible contributions reduces taxable income in the year they are made. So the major difference is no deduction. Yes, you do get some deductions. The cons are no immediate tax benefit, ability to contribute is phased out of higher incomes, as we spoke here in the previous slide, the AGI. For traditional IRA, deductions may be phased out, distribution requirements are ordinary income. So that's the one I think explained required minimum distributions. So any money sitting in traditional IRA or 401k, you have to start taking required minimum distribution at the age of 79. And that's when it gets taxed as ordinary income. And if you want to avoid that, you have to do Roth conversion in the years you don't have any income. And there are some withdrawal rules As you can see, they are contribution can be withdrawn anytime, tax and penalty free. Unless you meet an exception, early withdrawals of earnings may be subject to a 10%. And here, yes, in traditional IRA, there is no way out. You have to pay 10% penalty and 1% to the state. So this is the basics of Roth IRA and traditional IRA. Anything looking at this, anybody want to ask me or clarify anything?
That's good.
Okay, I'll move to the next slide. The other option you have as a W-2 earner is maximize your HSA contributions. So contributions to HSA are deductible and the withdrawals are tax-free as long as you use that for your qualified medical expenses. And this HSA is only applied or even provided an option to people with high deductible health coverage. If you are a business owner, you can have your own business account as an HSA account. If you are an employer and if your employer offers you, you can use their HSA account. As you can see, you can contribute up to $3,650. The numbers may go up in 2023. And if you are 53 and older, then you can contribute extra $1,000 in HSA. I already spoke about this separate. Yeah. So another very point that you should have your own HSA for yourself and for your spouse. I have noticed people, they just go open HSA account for both husband and wife, one account, and they don't feel the difficulty till they reach the retirement age when they do not allow the wife to, or the other, either way, to contribute $1,000, extra $1,000 in HSA account. So it's better to have your own HSA account going forward.
So even if the wife does not work, you can still have.
Yeah, so that's what happens. Usually that is when people have only one HSA account, and which is okay to have. But I know I had a couple, they were like 70 and a half, and I think he was 65 years old, and his Medicare was going to start. And I told him, okay, go ahead and contribute this much. But his wife, extra $1,000, this $1,000 was denied because it wasn't the spouse HSA, it was the husband's HSA. And that is when we told him, no, your wife has to have your own HSA account to even have that extra $1,000 contributions. So, and also you can use HSA for your paying Medicare premiums after age 65. You can use this account. So it's a great deal. It's a great tool to have. Contribute $6,500. Earnings are tax deferred. If you use it for medical expenses, it's tax-free money. You will never pay tax on that money. And each spouse, either husband or wife, so that is the reason husbands always kept their wife together, because they were paying expenses for them and it is okay. But if wife can pay for husband, husband can pay for wife, either way is fine. So that's why sometimes it's commingling and it is okay, but the IRS guidelines say that they should have separate ones.
One question on the second last point, like Medicare can use HSA account to pay Medicare premiums, but Medicare premiums are already tax deductible, right?
Yeah, so, yeah. So, when you turn 65, I think there are two types of Medicare premiums, Part A and Part B. And one, they already cover it and the other ones cannot be covered. So you can use this HSA account to pay those.
Okay, so it's after you reach a certain age.
Yeah, 65. Which may be a long time for many of you guys, but this is the one thing out there for everyone. And we all are getting old. I'm getting old too. So I know I have an eye on this.
I have one question.
Sure.
So I have my business account. So to create a HSA account, do I need to create another account in the bank, or like while I just do taxes, I can just show some amount in HSA, label it as HSA?
Yes, you have to label it as HSA, and you have to have a separate account for HSA, because HSA is like, it's separately maintained account, like how your traditional IRA is maintained. The same way HSA is maintained separately. And I think you can open with any brokerage account. You can just tell them, hey, this is my HSA account, so they can label it. And there are rules and regulations for HSA, so you have to follow in that. category, and they will track your HSA contributions and distributions.
You can go to your bank and they will open the HSA account, or
I know Fidelity has HSA, Fidelity provides HSA, Charles Schwab provides HSA. So all these brokerage accounts will be able to help you open HSA account.
okay.
Can you withdraw money from your HSA account?
Only for the medical expenses if you do not want to pay taxes. If
Okay.
you withdraw money from your HSA account to go on vacation, yes. You
So
have
what
to.
is- So what is the tax limit on that?
I think it's going to be same rate, whatever tax bracket you are in, plus you have to pay some penalties, which is going to be, I think, approximately 10%.
Okay.
So, but usually people don't, because the money we contribute is only $6,500, which, maximum I think is $7,300 for the family. So, it takes years to grow, and your medical expenses are going to be higher in your old age. So people usually don't touch. I have always noted people pay their copays or medical expenses like glasses and all those things through this account, but they do have a receipt. So when the money leaves your HSA account, do you think you have to let them know why it was used for, or you may have to provide receipts for them to code it as a distribution?
Okay, so it means the brokerage can distribute that HSC amount to a different funds, right?
Yeah. So they give you a credit card. You have to use your credit card to pay for expenses. So when you contribute money, so your brokerage account will issue you a 1099, and it will show the contributions and it will show the distributions. And when you file the tax return, the contribution is important. At the same time, distribution is also important. And you have to specifically say in the tax return that it was used for medical expenses. If it doesn't, then you have to pay the tax plus the penalties.
So if you use the HSA account for maintaining your health, like going to gymnasium, YMCA, you can claim that way?
If your doctor prescribed you, that's what it needed, yes, you can. But just gym, it's a regular exercise, no. So if your doctor prescribed you that, oh, you need a pool in your backyard for this reason, then yes. But if you're just having a pool for your pleasure, then it's no.
Getting a health gym, going to YMCA. YMCA is like $120.
Yeah.
Make that $1,500.
And physiotherapy.
Yeah, physiotherapy, yes, I think, yeah, that can be medical expenses.
I think pool can also be a physiotherapy in your home, right?
Yes, but the doctors have to write it that you need this for this. But I wouldn't go that far. Pool is going to be like 100,000. So I won't even go that far. So I mean, you guys are looking for smaller, because the contribution you're doing is only 7,300 maximum a year.
And that is carried over.
Yeah, that is carried over. That it is your bank account. It stays with you as long as you're alive. It stays with you, and I think if something happens to either taxpayer or the spouse, it can be transferred to another person.
MINEKA, there is a question from Brother Askar in the chat. I think his mic is not working. Can you answer that? He has a question posted there.
Yeah, so the FSA is coming. Yeah, FSA, I know Askar is asking for FSA. I think I have it on the next slide, so I can go over that. Oh, he said my microphone does okay. So I think Askar's microphone is not working. So so I'll go over FSA account. I think it's on the next slide.
I have one last question. In traditional IRA, you said like 10% if you withdraw early.
Mm-hmm.
So does it include like you have to pay your tax bracket plus 10%, or just 10%?
No, it's the tax. So you have to pay your ordinary income rate. Suppose you're in 30% bracket, you have to pay 30% tax plus penalty on the distributions.
10% plus 30%.
Yeah. So to answer Askar's question, yes, FSA account need to be extended the same way. The same for HSA, no. FSA is different. HSA is like it's like your bank account with you for your medical expenses, and it stays. You can keep money as long as you want till your old age. And you do get a deduction for HSA. So that is why this makes it more lucrative. Okay, so I'll move to the next question. Next slide. Okay, so the FSA contributions. So yes, this contribution is offered by your employer, and you can take advantage of this and you can contribute. You know, as you can see, there's limits up for 2022, but we will have inflation adjustment, but it will be in the same range for 2023 year as well. As you can see, you have to use the money during the calendar year. That is the one requirement for FSA, which I know is very hard sometimes, but if you have a plan that, okay, you're gonna have these expenses, then might as well go ahead and contribute it. And there are many options for medical, dental, bandages, you know, all these things, acupuncture for yourself, and for your qualified dependents. So it does include variety in there. So I would say if you have a plan, like many times kids need braces, you know, it's expensive, and you can use FSA and use it up. And yes, it is, FSA is use it or lose it type concept. So be careful. If you put too much, you may lose it. And I think some employers, so don't take me, some employers may let you carry over only $570, which is not a lot, but something are out there. Another option I have for W2 people is dependent care. You can put up to $5,000 in your dependent care account. If you have kids, they are going to daycare, and if you are in a high tax bracket, probably you will not get the credit. But if you have the money in the DCFSA account, your money is already pre-tax, so you don't have to pay tax on that money, and then you can use it for your. So this is a good deal for people if they are in that range where their income is high, but they don't want to pay tax. So $5,000 is right there for you to use up. Any questions on this slide, guys?
Can we pay for the child credit, like for our parents coming from India who does not have green card or anything here?
This is only for the, I mean, you know, I have not seen, yeah, as you can see here in one of my comments, you know, elder care may be included too. But, you know, I have not seen people using it for elder care, because as you can see, you know, even this one, you have to use it up before the end of the year. So if you already have a plan, just their flight tickets, yes, that's not acceptable. That is not, you know, you cannot use it up, because if you submit the receipts to your employer that you are paying for the flight tickets and all this for your parents, probably that won't fly with them. But if you give them that, oh, your parents were sick and then you had to hire somebody, yes, that may work. But the parents have to be dependent on your tax return. If they are not dependent on your tax return, probably, you know, money putting in the FSA account will become taxable. So that's another thing to think about. Whoever is dependent on your return can only get this benefit. So, and, you know, it can cover, you can check your cover employers, you know, what they cover, what they don't. And, you know, it varies. Every company is different. So it varies. So you guys can figure that out with your employers. Okay, I'll go to the next slide.
It is the same way you create HSA account, the FSA account is created through the brokerage account. So
no, so the FSA is through employer. FSA and DFSA. So these two are provided by employer. You do not create an account with any brokerage firm.
if I have a business, can I open a FSA account?
Yeah, if you have your business, you can open your own account, yes. I mean, you may have to go through some rules and regulations. If you have an FSA, what you have to do, you can. I think you can. I have not seen people doing it, so it's very hard because many of the big companies are providing these benefits.
I have a question regarding FSA. So if the company is not offering HSA because they stopped doing it, is FSA a good idea still?
Yes, if you have a plan that you're going to use up the money, if you know that, you know, you will have, like, suppose you don't go entire 2,800, go like, okay, I will have $1,000. I would say go put in $1,000 in FSA account and make sure you use it up before the end of the year.
Okay, and also if the company doesn't offer HSA, is there a way to get it or is just?
Yeah, you can get it. You can get it on your own. But, you know, you have to be, you can put it on your own, but you have to be under that high deductible plan. So there's a rules around it. So you can put it on from your pocket as well. But I don't know how that will fly. Maybe I'll take down your question. I can get back to you on that one. If you are on a W-2, because if you are in a business, yes, you can have it for sure. But if you are on a W-2, I don't know if you can go and just open your own account and contribute it.
Okay, thank you.
Okay, so I'll move to my next slide. So this 529 plan, there is no deduction for this. There is no federal or state deduction, or maybe state deduction for some states. California doesn't have any state deduction, so I don't put any money in there, but I do have the money in 529 plan for my kids. As you can read this, you know, savings are operated in most states and some educational institutions. And I recommend to start as soon as possible, because that money you're saving for your kid. You can deduct contribution of federal taxes, but might be on your state return. There may be gift tax consequences. So in US, as a US resident, you are allowed only to give $17,000 to your kids or your parents. You can spend the money for the kids, but if you have to physically give money to someone, that is only allowed $17,000. In case if you ever give more than $17,000, then you have to file a gift tax return. That's another big area to discuss, because if you have generations living here, then, and so you have to start filing taxes. And suppose you have a mom and dad, you want to give 17,000 to mom and 17,000 to dad. So as a family, I can give, my husband can give, so together we can give 17 to my dad, 17 to mom. So, so it's like 17 sounds very small number, but when you take everyone in the family, it becomes a big number. So, you know, you can kind of actually give away like, you know, $30,000, $40,000 to your parents to live off. And if you are getting money from parents offshore, suppose your parents are in India and you're getting money from them onshore, there is no limit. They can give you as much as you want, but you cannot give more than 17,000. So that is the only big thing. And this is going to be, you know, one giant topic. I can talk for half an hour on this gift tax consequences.
So this is pre-tax or post-tax? You can give 17,000.
Post-tax. So this 529 plan is all post-tax. There is no pre-tax on this. But this is a good deal. This is, I just want to make people aware that they should contribute money to their kids' 529 plan. This is, if you have money, if you can put away some money, I would highly recommend opening a 529 plan for your kids for their college education. As you all know, the college education is becoming expensive day by day. So having money for them, it's a good deal to have. And as I have written here, it goes on tax deferred basis. Earnings and distributions are tax-free. So the contribution definitely is after tax. So you're not going to get taxed again. But any distribution of earnings, if you use it for college tuition, books, supplies, and room and board cost, it is, you don't have to pay tax on that money. So it's a good deal to have. And that is why I recommend everyone. You can,
and you can do that for grandchildren also.
Yes, yes, definitely.
And how much you should actually contribute?
I don't have the limit here, but I think the most limit is 17,000.
So I send my money to my parents. So I can just send to India 17,000, or I can send more than that.
You can, do you have mom and dad?
For my mom.
Just your mom. So I think according to US rules, you can only give 17,000 to one person. Suppose you have a dad, then you can give 17 to your dad and 17 to your mom.
But when you're doing a standard deduction,
Mm-hmm.
would then it be possible to get this tax deduction?
No, there's no tax deduction for gift. Gift is a gift, you just give it out of your heart. Especially you give gift to mainly, families give gifts to their grandchildren or children or the parents. And another good option you have, if you have money in 529 plan, you don't have to wait for your kid to go to college. If you can pay up to $10,000 in K-12 tuition per year for a beneficiary. So if you have 2 kids, you can use 20,000. So something to think about. A lot of people, what happens, grandparents, they put money in the grandkids account, and they can put actually $75,000 in 1 year, but they do have to file a gift tax return because they're allowed to only pay 17 per year. But I have seen that they will pay 17 or 75 or 100,000 for kids 529 account, and they file a return. Yeah, so other thing, the last everybody has this question, when a dependent student parent or dependent student 529 is reported as parental asset and is a relatively minimal effect on financials. So a lot of people don't open this account thinking that, oh, my kid is not going to be eligible for financial aid or any other things, but that is not the thing. This is treated as a parental asset. So if the parents are not able to use it for their kids, they can use it for the grandkids or for their own education. So I think that shouldn't stop you opening or contributing to a 529 plan.
Just my few things here. Like I was trying to open a 529 plan, but a lot of the brokerages which offer these plans, right? They have their own funds, like in which we have to invest, right?
Yeah.
So, and you cannot choose your own funds or your own equities or anything. And so that is like, I have to invest in whatever they have. So then that,
I know
that's an ethical challenge because a lot of the stocks and all, you don't know like what's going to be there in those funds, right?
Exactly. So now I have heard that from people as well, that is the one drawback 529 has, that suppose you go with Fidelity, they will only have certain funds you can invest in. You go to Charles Schwab, they will have their own funds to invest in. You cannot go by Amazon or Google in 529. I think you have to go with their funds. That is a one drawback. But if you're confident, if Fidelity or Charles Schwab, they have good funds, they're going to grow, it's a good deal. But if you're worried about it, if you want to buy like Amazon, Google, then yes, no, you cannot do that in that 529 account.
Yeah, it's more of an ethical question also, rather than a good investment or not.
Exactly. No, that's so true. So that's why I said, like it's a good option to have. People should have it, but you will have your own restrictions. Oh, I don't want this. I don't want that. I cannot do this. So yeah, definitely you have to think about your things, what's affecting you.
See, MINEKA, I have a question. See, in this PA 529 for this Pennsylvania, I think there are 3 types of funds. I think 3 types of 529 accounts that you can open. Either you can open as a GSP or IP or Keystone Scholars. So I think maybe the other brother, he was asking about the investment plan. That is the account, I think, 529. But in the GSP, I think maybe you can use as an education fund, right?
Yeah.
That is based on the credits which the college, they provides every semester. This is what the charges are for each credit, correct?
Yeah. So I may not be familiar with the Pennsylvania one, but yes, but all the concept is the same as the federal level. Whatever the federal does, that's what the state does too.
Yeah, I think that is depend on the rising tuition fees.
Exactly. Yep.
But
so I think if you're, if the brothers are more concerned about the ethical issues, I think maybe the GSPs will be the good option.
GSP, okay.
Guaranteed savings plan.
Guaranteed savings plan. Okay, I see. Yeah, that may be the good option. If the if this GSP may work out for people, if they can put money in, if they get a deduction, great. Even though you don't get a deduction, I still say do it. you can use it when your kid go to college, or if they're in private school, the earnings is going to be tax-free. And I think that's what GSP allows as well, I guess. Okay, any other question on this one? Okay, I'll move to the next slide. Next is capital gain. This is not a deduction, but a lot of people will have question about capital gain. I think I have put in a very simple words here. There are two types of gain, short-term and long-term. Short-term gain is sold within 1 year, and the tax rate is ordinary tax rate. So if you're in 24% bracket, and if you sold some stock, and if you have a gain, you will pay 24% tax rate. It's almost like earning money on a W-2, except self-employment tax. So whenever you are having a short-term gain, which a lot of people did last year, since 2020 until 2021, everybody was buying and selling stocks, and they all had ordinary tax rates. The second gain is long-term gain. If you hold it a stock for 1 year, and if you sell it after 1 year, you will have preferred tax rate, which is going to be like between 0 to 20%. As you can see, that I have put down the long-term rates. If you have a taxable income of 44,000, and if you have any capital gain, you will pay 0 tax. If you are in this range, and if you have some capital gains, you will pay 15%. Anything above 492 or higher, you will pay 20%. There is also net investment tax after Obama was the president. Sorry. You also have a net investment tax of 3.8% if your AGI is over 200,000 or 250,000. This was the only addition to fund the Obamacare. Nowadays we have that healthcare out there. So if you are above certain limit, then you will pay 3.8. So if you're in the higher bracket, you will pay 20% plus 3.8%, which adds up to 23.8%. Any question on the long-term gains? I'll move to the next slide. Tax loss harvesting. Tax loss harvesting is definitely a great strategy if you have a significant taxable gain in a certain year. I always recommend people to look at their portfolio before the end of the year, like maybe December first week. Just look at your portfolio and see how much capital gains you have. And if you have a significant capital gains, I would recommend looking at your other portfolio, which are losing ones. And maybe if you're not interested in the stock, just sell the stock to offset the gain. So you will not pay tax on the significant tax capital gains. And that looking through and selling before the end of the year is called tax loss harvesting. Next thing, when you're doing the tax loss harvesting exercise, you have to be aware of the wash sale rule. So wash sale rule, the way it works, you have to, a lot of people, they sell shares before the end of the year. As soon as January comes, they buy the same identical shares. And they think that they are going to get the losses, but that's not what happens. If you have sell and buy stock within 60 days, and especially during the end of the year, not anytime during the tax year, it's only between December and January, yes, that losses are going to be disallowed, and your basis is going to get adjusted when you purchase the same identical stock in the next year. So I dealt with a lot of clients who were under the impression that they sold it and they bought it and they were looking to use the losses, but they were not able to. And that's how these brokerage houses work. And that's what they reported to the IRS. So just be careful around December and January buying and selling stock, especially selling and then buying the identical stock. If you're selling and buying a different stock, it's okay. Any question on this one?
Just to add, I mean, this rule doesn't apply to cryptos so far, like.
Not yet. Yeah, the IRS is working on it.
Yeah, but if you have a loss in crypto, you can sell it and still get the tax loss harvesting benefits.
Yes. So yeah, we have to keep in mind crypto is a little different arena as of this point. IRS is working, as you have started seeing or noticing, that crypto companies have to start issuing 8949. They are giving to their clients. I have seen some clients because they had some buy and sell, but it doesn't apply in crypto for sure as of now. But I'm sure a few years down the road, we will have the same rule what we have for stocks.
Yes.
That is the reason they had too many IRS employees these days.
They're still behind. They haven't caught up with the last few years tax returns yet. So yeah, they're still behind. They're still hiring more people. Okay, any more question on wash sale? Just be careful, especially for stocks. I would say just be careful for wash sale. And I know, Abdul, you were looking for the tax loss harvesting. You can do that to offset any gain. Yeah, I'll move to the next slide. So those are all W-2. So I went over, if you're on a W-2, what are your deductions, what are your options if you have capital gains. Now, a lot of people, when they are in the industry for a long time, they go on 1099 or consulting or open their own business. There are various ways you can do consulting work or your own business. And these are the options. The first one is Schedule C. So if you are a sole proprietor, you can just go and then work with a company and they'll issue your 1099 on your name or social. That will get reported on your Schedule C. And you can report your income and expenses and you're done. You will pay self-employment tax. You don't need to do anything else. The next option is S corporation. This is my favorite. If you are a 1099 or consulting income earner, I like the benefit we get in S corp. You can do the same 1099 work. Go open an S corporation, give the employer W-9 for your S corp. You don't have to use your social. That is a great thing. They'll issue a 1099 or they don't need to. If in S corp, they don't need to give you a 1099. So you report your income and expenses on 1099, and it's a flow-through entity. So it will flow to you individually. You pay tax at the individual level, but you get a QBI deduction in this if your money is running through S corporation. I can talk for half an hour for S corp, but this is just I'm just giving you basics here, how you can do your 1099 work. So S corp is my favorite one. Next one is LLC or partnership. You can go open LLC or partnership as well. Same concept as S corporation, but you do not get the benefit of as S corporation. In S corporation, we do not pay self-employment tax. In LLC, we do. In S corporation, we are required to have a payroll, and that is the way you can pay self-employment. In LLC, we don't have to have a payroll, but any money flow to you as an individual, because this is a flow-through entity as well, you will pay tax at the individual level and you will pay self-employment tax over there. So Schedule C, S corp, and LLC are the options for 1099 or consulting work. C corporation is another option we have. They did have a good tax rate, 21% tax, but it has gone up now. This came into place after Trump was president. The tax rates were 28% or 32%, but it brought down to 21%, flat 21%. So people loved C corporations. But the only problem with the C corporation is, you pay double tax. You pay tax at the corporate level, and then when you take money out of the corporation, you pay dividend at the individual level. So this is not very lucrative, but this is option out there. So all the public companies have to be C corporation. So all these Google, Amazon, they all have to be C corporation, or they cannot deal at the NASDAQ, or they cannot have their own stock, public stock. So for smaller ones, I wouldn't recommend C corporation unless there is a reason to it, if you're a non-resident or something. But Schedule C, S corp, LLC is the option and is the way to go.
Is there a particular amount you need to open a S corp? If you make 100,000, you can open S corp?
Yeah. If you make 100,000, I would say, if you make 50,000 too, I would say just open an S corporation. It's easier. No, but does it help with your employment tax benefit? Yes, it does. It does help you. Suppose if you have 100,000 on an S corporation, You have to pay yourself a reasonable salary, which can be, you can decide your reasonable salary based on your income less expenses, whatever you're left with. You decide, you pay yourself, and then remaining can flow through you as an individual, and you pay tax. And then you get QBI deduction if you are below certain AGI limit, like I think it's 330,000 these days. So you get another 20% deduction. So you pay very less self-employment because you're paying yourself a less salary. Maybe, if you are end up with a net income of 60,000, paying yourself 20,000, 25,000 is a reasonable salary. So you're paying self-employment on 25,000. As compared to Schedule C or LLC, if you have 100,000, your net income is 60,000, you're paying self-employment tax on 60,000. So that is the difference between S Corp and Schedule C and LLC.
And with these corps, when we open them, and if we are taking the salary through either S Corp or LLC, how much max expenses can we show every year?
There is no max expenses. I would say report reasonable expenses, report the actual expenses you have done to earn that income. Suppose you are in a consulting income, you have to, you're earning like 10,000 a month. You have to, what is you're using, like your cell phone, internet, your maybe auto, you may have to drive to the office to do the work. So whatever you have expense to generate that income is definitely a legal expense.
Okay.
Yeah. So that's what I always recommend. And you can use your home office deduction if you have home office. A portion of your home and home mortgage and property taxes can be allocated as portion of home office. So anything within legal means, I would say, if you have support, just go ahead and report it and you'll be fine. So there are,
one more question, Manika. Can you convert a partnership into an S corporation, say after 2 years?
Yeah, you can. You just have to file a form called an election. So first we have LLC, we have to convert LLC to corporation, and then we have to file an S Corp election. So yeah, it is feasible.
So what is the max limit of losses you can file for LLC if you don't have an income in that business?
Yeah, so I always tell people, please just do not open LLC just to report expenses, because the IRS, the way IRS looks at it, that this business was opened with no profit motive. So you can report expenses for first few years, and it is okay because you are trying to generate business. But after 3 years, you are still reporting losses. And IRS has the right to come back to you and tell you that this business has no profit motive, and they will reverse all those losses for all the years you have taken, at least three years. They go 3 years back. They will reverse those losses and they will have you pay taxes on the income.
What if after the 3rd year you can file for bankruptcy?
No, you can. You can. I'm not saying necessarily you will get caught. It's like very less chances of getting caught if you're showing like a little bit expenses, 20,000, 10,000, 15,000. You can file for bankruptcy, but as you know, bankruptcy, I don't know if it'll affect you or just the business. It just, it's fine to have bankruptcy filed. And probably IRS will be happy because they know you were trying to do business and you couldn't, that's why you filed for bankruptcy.
I have a S Corp, and I spoke to my accountant. I was trying to figure it out whether is it good for me to buy a car altogether and pay it off in one setting, or just get a monthly payments.
You are planning to buy a car or you are planning to lease a car?
That's what I'm not sure. What shall I do? I should just buy it in once and report all that payment in one year, or just lease it and show it as a lease payment every year.
Yeah, if you ask me, I'm very conservative.
$8,000 car I can buy it if I buy it right now. like I will show it as in my S corp filing, then it will be like minus 48,000.
Yeah, it depends. You may not get entire 48,000. So if you ask me, I'm a conservative accountant. I prefer to buy a car because that's my asset. And if your car is above 6,000 pounds, then yes, you can deduct the entire 48,000 and reduce your income by that. But if your car is below 6,000 pounds, then you cannot. You have to depreciate it over 5 years or 7 years. So 48,000, you will get a deduction every year, but it's going to be a portion, like maybe 7,000 or 8,000 each year. And if you want to lease a car, it's perfectly fine. Entire lease expense will be deductible. So if you're asking which is beneficial for you, I would say buying a car is more beneficial because you have the car, you have an asset, you still get to take the depreciation of those assets, even though you don't take it in 1 year because it's less than 6,000 pounds. You will take it over the years, so your income will be reduced. And even after 5 years on books, your car has gone down to 0, but you have the car and car still has some value. So I personally feel buying car is a good deal to have. But a lot of people prefer to buy lease because they like to change cars every 3 years. And so I don't think, apart from that, there is no better reason I have found if you should lease or buy. I will always buy. But that's just me. So I'll move to the next one. So there are options. So SEP IRA,
Last
IFA 1K. Yes.
For you. So I have S corp and I also work as a part-time, like on W2.
Mm-hmm.
So what is this reasonable income? When I do part-time S corp also, it can be considered as a reasonable income, like.
Yeah, so your W2 is a W2. You don't have to worry about that because your employer is giving you. Suppose you are making 50,000 on S corp. You have expenses of 10,000, so you're left with 40,000. I would pay myself like 20 or 30% of 40,000 as a reasonable salary. And remaining you can take as a distributions, or you can leave in the company to cover other expenses. Okay, so there are retirement options. SEP IRA is another good one. I always tell people to go open SEP IRA if they are on Schedule C or LLC. You can contribute up to 25% of net income for Schedule C and LLC, and 25% of W2. Suppose you pay yourself 10,000, then you can only contribute 20,500 for S corp. So sometimes, it just you have to go what you're trying to achieve. I-401k is another good plan these days. I have seen a lot of people opening I-401k because you can do dollar-to-dollar contribution. So exactly 22,500 can go in 401k, and remaining can be distributed 25% of W2 as an employer share. So that's another good deal. If you are in a medical profession where you're making like 300, 400,000, I always recommend people going the defined benefit plan. If you have a business, if you're on W2, there's nothing you can do. If you're in a business, yes, defined benefit plan is the way to go. Any question on the retirement options? Okay, I'll move to the next session. Next slide. So a lot of people ask me, so I had this slide, but I'll quickly go over this. S corp versus LLC, maybe it's more important for us because a lot of people are from India, from different countries, so there is a comparison. So LLC can have unlimited members. S corp can only have 100 shareholders. LLC can have non-resident and non-US citizen, but not S corporation. So for S corporation, you have to be a US resident or a US citizen. So you have to be on a green card, or you have to be having a citizenship. S corp cannot be owned by corp, LLC, or many trust. LLC does not have this restriction. S corp requires to distribute equally. So there are two partners, 50-50. You cannot pay each other more money. You have to distribute 50-50. In LLC, you can distribute more. If you get paid more, maybe a taxable event, but yes, you do have that option. S corp requires to pay owner a reasonable salaries. LLCs don't, because LLC is a flow-through entity, so entire money will be taxed at the individual level, and you pay self-employment there. So that's why there's no requirement. I know I went very quickly on this one. Any questions? Okay, I'll move to the next slide.
So anybody like doing IT work from India, they can open a LLC in US?
Yeah, they can. A lot of people do. I know that.
And their tax bracket will be the same?
Yeah, they will be, their tax bracket is going to be the same, but the form they will be filing is different, because LLC, suppose LLC shows $10,000 income, they have to file tax return, or LLC will withhold. If it's a foreigner, if the owner doesn't live here or the owner doesn't have ITIN number, then the LLC is required to withhold tax. And I think the requirement to withhold tax is 30%. So on 10,000, you will withhold 30%, and you'll send it to the IRS. And the foreigner, the foreign partner, they can file their own tax return here. It's called 1040 INR. And if they think they don't owe 30%, they can get it back.
So all the H1 and H4 holders can open their companies here.
LLC, yes.
It's a good news for all the H1 holders in this team.
LLC and C Corp, they can go with C Corp or they can go with LLC, but the S Corp is the one restricted. They don't allow those.
So as soon as you join the company, you need to open an account.
Want to? I don't know. I didn't. I wasn't never on H1, but I know my husband was. He didn't, because that's the time we were just thinking to get a green card.
Yeah, I made a mistake. I should have done.
Yeah, your thought process is different when you are in that phase of life. When you come out of that phase, then you think, okay, I should have done that, but I didn't do it.
Yeah, but here the few brothers are there, but they can take advantage of this.
Yes, definitely. That's why I hope, after this presentation, people are more aware or more informed, and from this presentation, they will be able to make the right decision. I added this slide for real estate business income because a lot of people have rentals. And I just had a quick slide here that you can have rental income, and that income is going to be passive income. You do pay tax on the rental income at ordinary tax rates. If you have any losses on rental, which is called rental losses, they are not deductible unless you are a real estate professional. So, a lot of people come to me that, oh, I want to deduct these losses. You can if you want to take chances, but probably IRS will come knocking your door, and then they will reclass it back to passive. So that is one thing not recommended unless you have a spouse, a non-working spouse, and if she's paying or she's spending more time on the rental, then yes, you may have a chance of deducting the rental losses. There are rules for rental losses. You have to have 750 hours. So I don't know if anyone in that category, but that's for rental business income. Next one is personal residence. A lot of people will have this question, if they have a primary home, if they sell the home, are they going to pay tax on the entire gain? If you have lived in the home for 2 out of 5 years, then you can exclude up to 500,000 if you're married, up to 250,000 if you're single. So I highly recommend people to buy a house. If you have a plan to stay in the same city or state for a while, I highly recommend one way. And then losses on personal residence are not deductible because those are all considered personal losses. A lot of people turn their personal residence into rental. And suppose if you sell the rental at a loss, then a portion of the loss may be deductible as a capital loss. But it has to be a rental property for at least 2 years. Just because you want to claim the losses, you turn it to rental and you claim the losses, it doesn't work that way. So there are rules with that as well. And also, if there is a gain, you turn into a rental, and if there is a gain, you can still exclude it if it's sold within 3 years after you moved out of the property. So any question on the rentals or personal residence exclusion?
So if you buy a house and say for any reason you sell within 2 years and you make gains, you are going to pay taxes on that, right?
Yes, it will be prorated though. So if you sell it before
Okay.
2 years, your exclusion will be prorated. So suppose after 2 years it's 500,000. Before 2 years it will be like 420,000 maybe.
Okay.
So
And
it will be prorated.
the income we get from rental or by selling a house, that falls under capital gains, just like any other investment gains, right?
Yes, ordinary rates. So there is no preferred rate. So rental income is going to be taxed as your W-2 gets taxed or your interest income gets taxed. Same way
Okay.
your rental income gets taxed, ordinary tax rates.
Okay. My question was, is the rental income considered as a capital gain? Or if I make money by selling a house, if I profit from the house, is that a capital gain? Because capital gains are different types of gains, like stocks, you have capital gains, right? So
Yeah.
does that come under that?
Yeah. So if you sell your
Okay.
house, yes, it is going to be considered capital gains.
Okay.
And if you hold the house for more than 1 year, then it will be
Mhm.
long-term capital gains. That is a
Oh,
preferred.
so basically the same rules apply here. Okay, got
Exactly.
it.
Same capital
Okay.
gains. Yeah. Long-term cap gains, same. If it's a short-term, then you pay ordinary rates.
Mhm. Okay, thanks.
I have one question in the chat. How much are the taxes on money received from parents or siblings from overseas? There is no tax if you receive money from your parents as a gift or inheritance. I think those are the only two options. Inheritance or gift, there is no taxes owed. So you don't have to worry about it if you get money from parents or siblings. They have to worry about it. I don't know about Indian or other country rule, what the regulations are. I'm just aware of if you have to transfer to them, you can only transfer certain amounts. Or you are giving them more gift than the IRS has laid out for everyone here. You can give them.
MINEKA, if you are sending money to your parents back in India, do you need to, you can send it after your W-2, or how you can send it?
Yeah, after W-2, because this is going to be all after tax money.
So that can be deducted?
No, that cannot be deducted because gift and those things are not deductible.
You cannot send more than 17,000 per parent.
Yeah, per parent, yeah.
Yeah, even though if you're sending 17,000, but that can't be deducted. So it's no case, no way that you can file for those deductions.
Yeah, no, it's not deductible. And it's each year. So, sometimes if your parents really need money, we always recommend saying that, okay, do it in December, say, 36,000 now, or do it in January. So it ends up giving you 70,000, 80,000.
MINEKA, I have a question about the land trust. Say, for example, if you open a land trust and have your S corporation or LLC in that and buy a house under LLC, is the tax that will be on LLC or on your personal income? If you sell
so LLC is a flow-through entity. So anything you do in LLC, it will flow to you as an individual. The reason people put residence, especially rental, not personal residence, I have not seen anyone putting in LLC, but rental properties, they do put in LLC. And the reason is because you want to protect your identity. You don't want to give your social and name to anyone. So you use the LLC name and ID to give out information.
So the tax will be on the LLC itself, right?
No, so, is it a rental property?
Rental property, yeah.
Yeah, so you will report all the rental income and expenses on the LLC, but LLC itself doesn't pay any tax. So any income reported in LLC will flow to you at your individual level on your 1040, and you pay tax there.
But it won't be a passive income for me, right?
It will, real estate is a passive income. Okay. It is your LLC and it is flowing to you. So it is your passive income, even though it's LLC's income, but technically you are the owner of the LLC.
And the LLC, if it's under land trust, still it's considered as a entity for me. Like I'm the owner of that.
Is land trust, is it something different? Maybe I may not be catching it. Land trust, I don't know. It's a trust, it's a separate trust.
Yeah, it's like it's a separate trust.
Oh, okay, then if it's a separate trust and if it's not a grantor means, you are the owner and everything gets reported to you. then you may have to file a separate tax return for that, and nothing will flow to you individually. And most of those are irrevocable. That's what I know the term out there for federal, it's irrevocable trust.
Okay.
So maybe that land trust you're talking about, maybe falling in that irrevocable trust category, then it will stay in the same trust. And I would not recommend doing that because the trust tax rates are pretty high. If you know, many times this happens when both parents pass away. We do keep my property in the trust. If not needed, don't keep it in those kind of trusts where it's stuck in there. And you don't get stuck up in basis as well. So those are all different, it's a different area and different.
Can I include my rental property in my S-corp business?
You can, yeah, you can. I mean, there is no harm to it. You just have to report as a rental income and expenses on a separate form, but yes, you can.
Okay. So I have an LLC. So can I do different types of businesses on the same LLC?
Yeah, you can. You can do rental, you can do consulting. But as an owner of the LLC, I think you want to know from this business, what's my profit, from this business, what's my profit. So you just have to maintain your own accounting. Like if you're a jewelry business, you want to have your accounting for jewelry business. If you have a restaurant business, you want accounting for restaurant business. You'll be filing one consolidated return, but as an owner, you should keep track.
Okay, I can have same LLC for that, right?
Yeah, it's perfectly fine.
Okay, thanks.
I'll move to the next slide, guys. I know we're almost done. Next thing is Social Security. I don't know how many people are looking for this topic, but I just added a very basic information here. You can start receiving Social Security as early as age 62. You only get full benefits if you start after the retirement age 70. It used to be 65, 68, now it's 70. You can very well start your Social Security at the age of 62, but the benefits are reduced at a small percentage for each month before full retirement age. The way I look at it, you know, Social Security, I contribute to the government. It's like my bank account. I pay them every month through my paycheck, and my bank account is sitting with the government. If I start money at the age of 62, probably whatever my bank account is, they will start giving me money. If I start at the age of 65, probably my bank account has grown because the money has earned in the same account, so the benefit increases. And if you keep the same bank account, don't touch at all at the age of 70, it increases even furthermore. So that is the whole concept. Then the longer you wait, your benefits are more, you get higher Social Security paycheck. But to me, it really doesn't matter how you want to start. But recommended age for everyone, people are saying, and most of the people are following, they don't start until age 70. Some people do start at 65, and it's perfectly fine. It's what you want. Next one is Medicare eligibility. It's eligible at the age of 65. You have to be a US resident. You will be eligible for that only if you are disabled. And if for some reason, if you decided to delay your Social Security benefits until 70, you should still apply for Medicare benefits within 3 months of your 65th birthday. So this is just a very basic information. There's so much into the Social Security Medicare out there. So many questions people have, but this is just a basic. I have it here for you guys.
Do you need to pay taxes on your Social Security benefits at the end of the year?
Depends. Suppose you have Social Security. If you are 65, you started your Social Security, so you're getting 40,000 in Social Security. You have some interest and dividend, and keep in mind your 401k, the RMDs will start at 70.5. So if that start as well, suppose in 65 you don't have anything, you have only Social Security, you will not owe any tax on Social Security because you don't have any other income coming apart from that. But if you have other income, suppose your dividends and interest, or just dividend only, your capital gains is 100,000, Social Security is 40,000, yes, you will pay 80%. So your 80% of your Social Security becomes taxable.
And to be eligible for these benefits, we need to be employed for at least 10 years, right?
Yeah, I think that is
Okay.
the rule. Yeah,
So every year we get 4 credits, which makes it up to 40 credits.
yeah,
And after 10 years, you will be able to utilize this
utilize this.
obviously by 62. But if something happens in between that 10 years and you hit 62 years of age, you still can utilize Social Security. Like if you get disabled or something happens to you, like,
Yeah.
your family can benefit from that, right?
Exactly. Like many
Okay.
times, I know one of my friend, the husband passed away. The wife, not wife, but the kids are getting Social Security. So whatever he has contributed to the system, the kids are getting benefit for that.
Yeah, that's
And
that's
this
the
Social Security benefits can be withdrawn from anywhere in the world, correct?
Anywhere in the world, yeah, you can
Yeah.
live in India or any other country, you're fine. It will just come directly to your bank. In fact, you can give them your foreign bank account. It can come directly to that bank account.
These benefits are available for H1 people also.
If people do pay Social Security, as you have to be a US. I mean, you are considered a US resident when you are an H1. I know there were some people have gone back, as you know, because the visa didn't get extended or things. They cannot withdraw their Social Security till they turn 65 or 62. So it will be available. It's there in your bank account sitting there, but you can't use it till your old age. So I don't know what has happened because I'm still young. I'm not there yet. So I haven't seen that phase yet. But
I think they can.
Yeah,
Yeah,
they can.
but it's the same thing, right, MINEKA? Even if you're a US citizen, you still have to wait till 62. But even on a H1B, if something happens to H1B guy or something happens, as long as he has earned 40 credits, he's still eligible for that, right?
Exactly. Yeah. So it's available definitely. But I think I'm worried. What if they forget? They don't remember that they have to use and they have to do all those, paperwork to get the Social Security started.
Right.
Yeah, but they have to be locally in the country, isn't it, to get the Social Security?
No, you don't have to.
No.
You can live anywhere in the world and you can get Social Security. You just have to do the paperwork and get it started because the money is there with the government.
Okay.
Yeah, everybody stimulus. The stimulus was coming out, in 2020, 2021. Everybody got stimulus, even though they were not even living here. They were in India. So sometimes, yeah.
So the bottom line is we have to focus on getting the 40 credits, 10 years, 10 years of employment, at least on H1Bs.
Yeah, definitely.
Okay.
Okay, so I'm moving to the next slide, tax credits. I'm just going to quickly go over this. There are so many tax credits available for people. There are some are refundable and some are non-refundable. As you can see, I have listed dependent care, electric vehicles, education, efficiency credits. If you do some energy efficiency, washer dryer, or any work in your house, please do take credit. You have 30% credit out there for those things. Solar, if you're putting solar, you'll get, if you spend 10,000, you'll get 30% of that $3,000 credit. These are non-refundable credits, but if you have taxes owed, they will be able to reduce your taxes. So please do take advantage. If you have a kids going to daycare, take dependent care credits. There are a lot of vehicles out there have electric vehicle credit. Tesla has stopped credits now, but there are so many out there. If you buy any vehicle, please use that credit. If your kids are in colleges or higher education, 4-year degree or higher education, please use education credit. They're out there for you guys. They're non-refundable, but you'll reduce your income. These are the refundable credit, earned income credit. If your income is below a certain level, you do get some. It's not a lot, but you do get some earned income credit. Premium tax credit is for the health insurance. People, especially on businesses or 1099, they are applying for this health insurance from Marketplace. They do get some credit. If you are above the poverty level, you do have to pay it back. But if you're below the poverty level, you get it back. You get the credit. Same American opportunity is the same 4-year degree credit. You get first 4 years of college. And child tax credit, everyone's getting it. And everybody got money this year in their bank account from the IRS for the child tax credit. For some people, it was good. For some people, they had to pay it back because they were not eligible for child tax credit. So these are credits available. please be aware and use it. Ask your CPAs or whoever you're dealing with, just ask them these questions. Probably they should be able to answer you. Then I'll move to the next slide. This is the last slide. This is not related to taxes, but this is one of the important things everybody should have. I always recommend people, if you're married, it's fine to not have a trust, but as soon as you have a kid and you have a house, this is the most important thing. You should do the first thing. You shouldn't wait, have a trust and list everything in the trust, your structure, your bank accounts, your house and everything. Because we never know what can happen to, so if only if something happens to one spouse, it's okay, the other spouse will take care of other things and they will take care of the kids. But if something happens to both spouses, that's when the kid is going to be in a devastating situation. So please, this is the ultimate important thing everyone should follow. There are so many things out there, but I know I have this basic thing, just have the trust. Trust can be structured to take effect before death, after death, or even when you're incapacitated. Because you have to list out everything in there. What do you need to do? You know, you'll see when you'll go through the trust with the attorneys, you'll see the questions they ask. It makes you think, really, do I have to answer this question now? But it's worth it. Just do it for your family. If there is no trust in place, suppose you have a house and bank account and there is no trust, then it goes to the probate court. Your kids have to fight in the probate court and it's going to be expensive. Probate processes are very lengthy. You have to pay money to court, the lawyers, and it's going to be very expensive. So you don't want to be in the probate court for your own house and money. So this is one reason you have to have a trust. And another example is in probate court, what happened, you have to go to each state and fight for those assets. Suppose if you have 3 houses in different states, you're fighting with each of those states to get that asset back and put it on your kid's name. So that will result in additional cost. A lot of people ask me why not wills, because in India we all have wills. As wills are not as effective as trust, especially in US. In India it works, here it doesn't, because it's not as authoritative as trust. At the same time, you have to pass first for the will to be in effect. As compared to trust, you don't have to pass. Even before death, the trust can be structured and it can take effect. Will has no legal effect, even though you are incapacitated. Suppose you're in a situation you can't talk, you can't say things. The will has no value, nothing. So that is why trust is very important and everybody should have one. I think that's all I have, guys.
MINEKA, thank you very much. I think we all enjoyed, and we were keenly listening to all the knowledge that you have. We're here at an hour and a half, and looks like we're still enjoying it. I just want to quickly share my screen here. That's okay, and
Sure.
do my spiel for the end. So thanks everyone, guys, for sticking around. Let's see. So we took the questions and answers, I believe, in the sessions. And if you have any further questions, please do ask, and I'll provide here some contact information from MINEKA if you have any questions for her. Her number is right here and her email address is available. And Abdul Bhai was actually instrumental in creating this event for us. So if you have any questions for MINEKA, you can also go through Abdul Bhai. He's aware, and mashallah, he'll be able to provide his insight as well. And also a special thanks to Imran Bhai, who was able to facilitate putting this event together for us. Lastly, before I let you guys go, you guys know about HACPA. Alhamdulillah, we're trying to come together. As we're a small group of families, we're trying to come together, see what we can do to give back to the community, and trying to organize programs like these so that we can benefit the community together. So please see if you can help us, donate us, become part of us, become members and such. And if you need any contacts from HACPA specifically, Abdul Bhai is already here. He's the secretary for the team. Nawaz Bhai is the treasurer, so all the monies will go to him. Rizwan Bhai is the vice president. And just in conclusion, thank you very much, MINEKA, for giving us your valuable time. It was very, very beneficial for the entire community. On behalf of HACPA, I especially thank you for spending your time with us. This was very informational, and the recording for this will be available shortly, maybe in about a week or two. We'll try to process that together and put it out there. Because it's the end of the year, HACPA is almost going to have one of its last event for this year. We're planning to have a potluck amongst our as a group together, and we're still planning that. So please keep an eye on that invitation to come through sometime in. We're probably thinking about second week of December or the first week. We still haven't finalized that date. So that, and then there'll be, of course, elections, and there will be selections of the next council to take the reins and take this to the next level. So again, once again, on behalf of HACPA, thank you guys for sticking around. Thank you very much for attending today's evening. I hope you benefited from this. Please make dua for those who are involved in organizing this, and a very special thanks to MINEKA. Shukran. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.
Thank you, MINEKA.
Thank you.
Thank you,
Bye.
MINEKA. Walaikum assalam.
Thank you so much.
Thank you.
Bye.
Bye.
Thank you.